Good morning, everybody. Hope you had a good weekend, and welcome to the Monday call. As usual, this is our time to talk about things that have gone well, gone poorly. If you have a headset or have called in, it'd be a wonderful time for you guys just to speak up, and we'd love to talk to you and share anything that's gone well, or if you're having some hurdles, we'll help you overcome those. So as we're waiting to see if anybody has those issues going on, I will interrupt Jeff as he gets into the presentation. But Jeff is going to be going through some of the things that we talked about at the disclosure meeting, and it's an important thing, and we get lots of questions on it. So he was nice enough to cover that this morning. So please listen up. This is excellent material for going for understanding how the disclosure works. So thanks, Jeff. Go ahead.
Sure. Well, good morning, guys. And actually, I wanted to start off with a pointer. So as we're going through that, if you have any questions for Mike, just go ahead and type them in. And if we get any, we'll go ahead and share those just after the pointer. I know that everybody benefits. If somebody has a question, then chances are a lot of people have the same question. So if you have anything that's going well or anything that's not going well, we'd love to hear from you. The pointer that I actually have for you today, and let me pull it over here onto the screen. Hopefully you can see this. It's actually an article from the Wall Street Journal from March of this year. So it's funny how things come full circle, but it says, say goodbye to the 4% rule. So we've talked about in the past the fact that the idea that you can withdraw 4% from a portfolio adjusted for inflation has actually been questioned a lot in the past. So it starts out by saying, can your nest egg last your whole lifetime? And it's getting tougher to tell. Conventional wisdom says that you can take 4% from your savings the first year of retirement and then that amount plus more to account for inflation each year without running out of money for at least 3 decades. And that 3 decades is important because people are living longer and they're retiring earlier. So it's not uncommon for somebody to retire in their early 60s, say 62, and live to be 85, 95 years old, in which case that portfolio has to last 25, 30 years. So it goes on to explain that the 4% rule was devised by a planner named William Bengen, and then it was kind of later refined by other retirement planning academics, and what they said was you could actually take out 4.15% adjusted for inflation each year for that 30-year period that they studied going back from 1926 to 1955. Well, the third paragraph says it was beautiful while it lasted. In recent years, the 4% rule has been thrown into doubt thanks to an unexpected hazard, the risk of a prolonged market rout the first 2 years or even 3 years of your retirement. In other words, timing is everything. If your nest egg loses 25% of its value just as you start using it, the 4% may no longer hold, and the danger of running out of money increases. So it says if you retire January 1st, 2000 with an initial 4% withdrawal rate and a portfolio of 55% stocks and 45% bonds rebalanced each month, with the first year's withdrawal amount increased by 3% a year for inflation, your portfolio would have fallen by 1/3 through 2010. Now, guys, let's stop for a second and think. 55-45, that's a pretty conservative portfolio. And even it wouldn't last through this 3 decades, or there's a high chance that would run out of money if they were using stocks and bonds. You'd be left with only a 29% chance of making it through 3 decades, and that's according to T. Rowe Price. So that has a lot of people, a lot of baby boomers really worried. And it says the mind-blowing aspect of retiring is that all these years you're accumulating and accumulating, and then when you need to start drawing down, you have no idea how to do that. So the point of this article that I wanted to bring to you is not the fact that the 4% rule is kind of running out of favor. What I really wanted you to see is what they see as the solutions. And they give 3 solutions. So now you know we've come full circle, because here's what the Wall Street Journal is saying. Use annuities instead of bonds. So don't use bonds anymore. Use annuities. You know, when I first started working in this industry, and it would have been 12, 13 years ago, annuities was a bad word. And you'd never see a positive article about annuities in the New York Times or the Wall Street Journal. But now, all I see in the New York Times and the Wall Street Journal are positive articles about annuities. And now the Wall Street Journal is saying, you know what, maybe bonds aren't such a good idea. In fact, maybe annuity in place of bonds is the best solution. So it says pairing the most plain vanilla type of annuity called a single premium immediate annuity, and guys, I'll make the argument here in a second that we actually have a better product than that in our arsenal. We have annuities with income riders that are supercharged immediate annuities. But pairing that with stocks, retirees can generate income more safely and reliably than if they used bonds for that piece of their portfolio. So it says to arrive at that conclusion, this financial planner plotted how 1,001 different product allocations might work for a 65-year-old married couple hoping to generate 4% annual income from their portfolio. So using 200 Monte Carlo simulations for each product allocation and assuming returns based on current market conditions, so real-life returns, the winning combination turns out to be a 50-50 mix of stocks and fixed annuities. If inflation accelerates more than the markets now expect, inflation-adjusted annuities would become more attractive, he adds. There is no need for retirees to hold bonds, he says. Instead, annuities with their promise of income for life act like super bonds with no maturity dates, he says. So he goes on to say immediate annuities have one big drawback, that they lose their savings, that they have to annuitize or give up control of that money for that guaranteed payment. Like I talked about, we have products now that generate better income that you don't have to annuitize. So 50-50. 50 in stocks, 50 in fixed annuities. That's the best allocation. Because they go on to give two other solutions. One is follow the taxman tables or take your withdrawals based on the mortality tables. And the other one is peg your withdrawals to stock valuations. But the problem with those two is your withdrawals have to change. They have to start low if you use the taxman table strategy and then build up, or they have to maybe start at a certain place and then have to go down if the markets tank.
Well, let's talk about that for a second. So how idiotic would it be to spend less when you're young and a lot when you're old? I mean, how many of your clients want to spend the least amount of money when they're 60 and the most amount of money when they're 90? No. That's not the way life works. Life works where you'll be traveling, doing things, being active, buying motorcycles when you're 60, not when you're 90. So that you can throw that one out. And what was the second? Oh, the second one was, oh, great. So your life is gonna revolve around whether the market's going up or down. That's a fantastic way to. So don't get sick when the market's down. Don't let the roof leak when the market's down. Don't go on vacation when the market's down. So those two are not even viable. If you ask a retiree, hey, is that how you want to run your retirement? You are not going to find a single retiree who's going to say that's the way they want to run their retirement. So the only viable one is the first one Jeff gave, which is 50-50.
And that's the best advice now from he's actually with the American College of Financial Services, the people that hand out the credentials, the CFP and those types of credentials. So that's the Wall Street Journal, that's the New York Times, that's the American College of Financial Services, all saying 50-50 stocks and fixed annuities. So that is the pointer for today.
Well, can I jump in there?
Sure.
Point two. I've been in this industry for about 25 years, and I've been coaching for 13, 14 years. So I've talked to hundreds of advisors, and so I've either through myself or vicariously have helped thousands of consumers or retirees. Guess how many retirees ever run out money because they don't get a high enough return? So we're all worried about, hey, we can't have money just in annuities. We have to have a lot of money in stocks. We got to get them a high rate of return because, we need to keep them ahead of inflation. We don't want them to run out of money. Guys, thousands and thousands of consumers I've worked with through myself or my advisors I've coached. Guess how many of them have run out of money because of rate of return, because they got a 4% rate of return instead of a 6, or a 5% rate of return instead of an 8, or whatever. How many consumers, retirees have run out of money because the rate of return was not high enough? None. I've never heard of a single person that ran out of money because they had a 5% rate of return instead of an 8% of return, or a 4% rate of return. Is that, you know why? What causes them to run out of money? When the market, like Jeff's brought up, when the market's down 2 years in a row and they're still pulling money out because their accounts went down 50%. That causes them to run out of money. I've seen people run out of money because they lent money to their children that they shouldn't have lent. I've seen people run out of money because of medical expenses. So I've seen people run out of money because the market tanks and their accounts fall 50%. I've seen people run out of money because they've had medical expenses, because they lent unwisely too much money to their kids. But I have never, ever, ever seen anybody run out of money because the rate of return wasn't high enough. And yet, what do all of advisors out there chasing? I got to get this money manager because, you get a high rate of return and blah, 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 blah. No. Please name me a consumer, name me a retiree that ran out of money because their return was 4% instead of a 6% or a 5% instead of an 8%. They do not run out of money because of that. They run out of money because they lose a spouse and they lose that Social Security check the spouse was had, because the pension that their company had was all of a sudden is stopped, because a medical condition, because the stock market tanks 50%. That's why they run out of money. And Jeff said we had a perfect product for this 50-50 portfolio, but we've got an even better product, I think, which is the Wealth Max, which protects the client against what? All the ugly surprises. People run out of money because of the ugly surprises, not because they don't get a high enough rate of return. And yet, what do all advisors want to talk about? Rate of return, rate of return, rate of return. Clients do not run out of money because of rates of return. They run out of money because some major expense happens that they weren't prepared for. So you need to be thinking about that when you deal with your clients and how you allocate their funds. So thanks for letting me jump in there, Jeff.
Sure. Well, today we actually want to talk about how do you address no-load funds in a client's portfolio. So you run into a client who has a lot of no-load funds, or same thing with a lot of A shares. How do you talk about that, or how do you address that when you're in the disclosure meeting? And I always like to start this kind of conversation with a personal story. Whenever my wife and I go to the bank, no matter what it is, they always try and talk us into some other kind of an account, putting money in a CD or moving money here or moving money there. So one day we go into the bank and they talk us into this free checking account. And we think, well, heck, who wouldn't want free checking? So no problem, just what do we have to do? Well, you don't have to do anything. You just have to agree to do it. We'll just take the money that you have in your checking account right now, and then we'll just rename that checking account and the fees will disappear. So it's a no-brainer, right? So we go ahead and do that. We don't really look at our statements probably as closely or as often as we should. My wife is really responsible, and I trust her, and she checks the balances, and makes sure that they're about right. But she calls me at work one day, and we've probably had this checking account now for about 9 months, and she said, I was just noticing as I was going through this that there's a $30 fee, and I'm not sure what it's for. Well, the bank's always been really good to us. So I said, no problem, I'll just call them up and I'll take care of it. Well, I call them up and I ask them about this $30 fee, and they say, yep, there is that $30 fee. That $30 fee is there because of your checking account. And I said, but I thought we had free checking. Oh, well, that's only if you keep a minimum balance, that high balance in that checking account at all times. Your balance actually dropped a few times over the last few months below that, so we charged you that $30 fee. Now, because we don't check our statements very carefully, when she said that that had happened a couple times, I'm thinking maybe this wasn't the first time it happened. For all I know, we've been charged $30 every month for 9 months. And I started to get angry. So let me ask you guys a question. Why was I angry? Because the $30 wasn't a big deal. I wasn't angry about the $30. Why was I angry? I was angry because they told me it was free checking. and I felt like they lied. Nobody explained to me that if my balance dropped below a certain point that they would hit me with a $30 fee. I was just told, hey, it's free. And I guess for a while it was free. And I guess every time my balance was above that amount, I guess it was free too. But nobody told me that there was the possibility of this $30 fee, and that made me angry. Angry enough that what do you suppose I did? I left that bank. I moved my accounts because I wasn't going to work with people that I felt like I couldn't trust or that I thought were dishonest. Now, did they really lie to me? No. But did they tell me everything I needed to know to make a good decision about whether I wanted that checking account? No. And even though it was a big hassle because we do a lot of banking online, we pay all our bills online, so moving from one bank to another is not easy. You have to redo all of that stuff. But I was determined to go to the trouble because why? Because I felt like they hid things from me and I didn't trust them any longer and I didn't want them making any more money off of me. So how do we talk about no-load funds in a client's portfolio? Because I get calls all the time. A lot of times I'll do case analysis with people, and a lot of times the calls that I'll get are, gee, Jeff, I ran into a problem. I have this client and they've got like $500,000, but most of that money are in no-load funds. They're with Fidelity or they're with Vanguard, so I'm not sure what to do. And see, really what they're saying to me is, I'm not sure how to talk about this because the fees, they're not going to be high. It's kind of like that $30 banking fee. It's not going to be a big deal to somebody who has a $500,000 portfolio. But just like me with the bank, there is something that will make them angry. And what do you think it is that's going to make them angry? Because when they think that they have a no-load fund, what do they think no-load means?
No load.
No fees.
Yeah.
No charges. So the one thing that will make them angry is if they find out that there is actually some cost to having these no-load funds, only it wasn't explained to them. And the cost that you're going to typically run into when you run across these kinds of accounts are the turnover costs. So where and when do we bring up turnover when we talk to a client and go through their portfolio? Well, we do that at the disclosure meeting when we talk about fees. So let me just talk about fees in the disclosure meeting here for just a second. When it comes to fees in the disclosure meeting, I always counsel people to kind of lead with your very best card. And so what do I mean by that when I say lead with your very best card? Well, what I mean is that some fees are easier to talk about than others. So the best fees to talk about, the fees that get people the most angry, the most upset all of the time, are when they have variable annuity fees, that insurance expense, or when they have a 12B1 fee with a B or a C share, or when they find out that the value of their bonds can really fluctuate. They don't go up a lot, but they can sure go down a lot, and they can go down fast. They don't think that bonds are things that can go down at all. Or when you talk about preferred stock or REIT. So if you look at the top of that list, when we start with VAs, those are the easiest things to talk about that get people the most angry. And as you move down the list, they become a little bit more difficult to talk about. I would say the best things to talk about are VAs, B and C shares, and bonds. The second best thing to talk about would be preferred stock REITs, A shares or no-load funds. And then the last thing that I would want to have to talk about is managed money, though I could. I'm just saying the most powerful are at the top, and they get a little less powerful as you move from top to bottom. So if I had a portfolio that had VAs, managed money, and some CDs in it, what do you think I would talk about first? The VAs, because that's the most powerful thing. Well, what if they had a $500,000 portfolio and they had an $80,000 variable annuity, $400,000 in managed money, and $20,000 in a CD. What do you think I would talk about first? I'd still talk about the variable annuity first, because that's the thing that I know is going to get them the most riled up. And then I always say kind of stop after playing your best 2 cards, because you don't want to go through this litany and get people overwhelmed to the point where they're so overwhelmed that they don't know that they can do anything at all. So my point is, you're going to see portfolios. The typical portfolio that you're going to run into is the portfolio that has a little bit of everything. You're probably going to run into some people that have some no-load funds, a few C shares that are being managed by an advisor, some preferred stock, and then some bonds and some ETFs. That would be typical. Well, what I would tell you is rank all of those in order of most impact, and talk about the thing that will have the most impact first, and then move your way down. And you really only need to talk about 2 things, because the point is disclosure. After a while, they're going to get the fact that, yep, I'm not being told, I get it, I'm not being told. Okay, so you may or may not end up talking a lot about no-load funds. But there are going to be times when that's predominantly, they might have a few bonds and some no-load funds, in which case if you're going to talk about a couple things, you'll talk about the bonds first, but you will end up talking about the no-load funds. But always talk about the things that have the most impact first. So typically this won't be the thing that you lead with unless it's all that they have. You'll probably lead with other things. You may not even get to this if it's not one of the top 2 things. But if you do end up talking about this because this is what they have, and it's probably one of the 2 things that they have, don't worry. You can still have a good conversation, and it will still have a lot of impact. In fact, if you do end up talking a lot about no-load funds, it's probably a blessing in disguise. The reason I say that it's probably a blessing in disguise is because the reality is the costs will be low, and we'll talk about this in a second, but many of the costs will be intangible. Some of the bigger costs will be intangible. Doesn't mean that they're not real, just means that they're a little bit, they require more explanation and more discussion. But all of that forces you to emphasize disclosure as the issue. Because when we talk about fees, the biggest mistake that I see guys make is to get a big number, and their eyes get big and their mouth starts watering, and they think, wow, when they see that they're paying $11,000 in unneeded fees, they're going to move. Well, no. They're not going to move for the fees. I can tell you that from experience. I can tell you that from coaching. I can tell you that because they didn't even know they were paying the fee. It wasn't a big deal to them. It wasn't causing them to not go out to eat where they wanted to go out to eat. It didn't cause them to change their vacation plans. They didn't even know that they were paying that fee until you bring it up. And if they're angry about the fee, if they're really angry about the fee, they'll go back to the guy who put them in that investment and tell him, we're angry about the fees, we don't want to pay this anymore. And he'll take care of it. The only reason they'll move is if they thought that he hid it. And more importantly, they thought that he hid it on purpose. In fact, that's the problem that I had with the bank. I felt like they hid it. And I started to think that they did it on purpose because they just wanted me to move my money from the account that it was in to the account that they thought was quote-unquote better for me, without explaining all the details. So we're going to talk about how the details of these no-load funds often get hidden from people, and even though sometimes costs aren't as big as they would be in a variable annuity, maybe aren't as big or as bad as they would be in a B or C share, the fact that they were hidden and the fact that they weren't disclosed are the things that get people angry and make them think, I might not be working with the right guy. Because I don't want to work with somebody who doesn't tell me everything I need to know to make good decisions. So let's talk about what are the costs when we start looking at no-load funds? Well, the costs are trading costs. When we start talking about turnover, the costs of turnover are the fact that every time they turn a portfolio over or change from one stock to another, there are trading costs. There also could be tax costs. If it's a non-qualified account, probably have clients that have 1099s at the end of every year from their investments. We'll talk about here in a second how most of those 1099s come as a result of the turnover that's happening in that portfolio, so that even though they might not touch or change anything in their portfolio, they're still getting a 1099 on many of those funds because of the turnover. And then in addition to that, there's also an opportunity cost, and we're going to do some role playing here, and we'll learn what those opportunity costs are in a second. But the first thing to notice is that there isn't just one cost when we talk about turnover. There are multiple costs. And we'll find out that some of them aren't very high. Some of them maybe don't always pertain. The taxes don't always pertain if all of that money is in a qualified account. But some of them are high, even though they're intangible when we talk about the opportunity costs. But even though they're intangible, they're very real. So again, when we talk about no-load funds and we talk about turnover costs, we're going to do that in the fee section of the disclosure meeting. And hopefully all of you are using the proposal, because that helps make it tangible. So when we get to that page in the proposal, when we're talking about fees and we're talking about turnover costs, we're going to begin our discussion. And I call it a discussion because I'm not going to tell them how it works. They're going to be involved, and they're actually going to tell me how it works, because we're going to have a discussion about this. But notice, when you're using the proposal, it's actually going to calculate what the turnover cost is for you based on your inputs from the fact find and the Morningstar report. So you'll be using real numbers. We won't be talking about it in generalities. We'll be telling them, hey, there's $8,528 in turnover costs as a result of the investments that you have inside your portfolio. So would you like to see how we arrived at that number? And everybody's going to tell you, yeah, I mean, we want to know how you got that. So I'm going to start the discussion not talking about something financial, but actually talking about something non-financial. Because again, like Mike talks about, if it works that way in life when it comes to everything else, then when we start talking about the money, it works that way as well. What I'm going to actually talk about is a manufacturing plant. So I'm going to start asking them some questions about what would happen if you read something in the paper. So if you read in the paper that, let's just call it XYZ Manufacturing Company, had 50% turnover in employees at the plant, what would that mean? What does that mean to you when you hear that, hey, 50% turnover in employees at that plant? Well, they're going to tell you, well, what that means is, I guess half the people quit and leave, and they have to hire, you know, another half to take their place. And I'm going to acknowledge that and say, you're absolutely right. That's exactly what it means. It means that half the people are leaving and they're having to rehire or hire another group of people to replace them. So let me ask you this. Does the company like having that kind of turnover, or do they try and get that number down? Well, no, I'm sure they try and get that number down. Yeah, they do. They try and get that number down. Why don't they like that number to be high? Or why do they want that number to be low if they can make it low? Well, they want people to be happy. Yep, absolutely. They want people to be happy. So happy employees are what? Less productive or more productive? Well, no, they're more productive. Yeah, absolutely. So there's a productivity cost if you have all these people coming in the door. But also, you know, when people leave and they need people in, do people just know through osmosis that that company is hiring? Or sometimes what does the company have to do to get the word out that they're looking for people? Well, they might advertise, put an ad in the paper. Yep, they might put an ad in the paper. So There's a cost in time. Like we said, those new employees, are they going to be as productive as the old employees right out of the gate? No. So they don't like that there's downtime in productivity. Also, that ad in the paper, is that a cost to the company? Yeah, I suppose that's a cost. I mean, putting an ad in the paper doesn't cost a lot, but don't they have to interview those people? Yep. Don't they have to train those people? Yep. And do the trainers and the interviewers all work for free? No, I'm sure they don't. So there's all kinds of hiring costs. It's not just the ad in the paper, it's what else? Well, it's the interviews, it's the trainers, it's all that stuff. Right. So it's not just one cost, it's what? Well, it's a lot of costs. And those costs are real to the company, and as a result, they want to do what if they can with that turnover number? Well, they want it to be low. So guys, they're telling me that's how it works in life. We want the turnover to be low because why? Well, because there's a lot of costs involved, and there's productivity, there's hiring costs, there's training, and if the company could avoid all of that, that would be ideal because that would help their bottom line. Well, now we're going to talk about investments, and I'm going to tell them it's exactly the same with our investments. So your portfolio averages, I'll just say 83% turnover, but the number I'd actually use with them is the number that I will have actually calculated, or that the proposal will have actually calculated for you. It'll tell you exactly what their average turnover is so that you'll actually be giving them their number for their portfolio. So let's just assume for a second that it's 83%. And say your portfolio averages 83% turnover. So what does that mean? Well, unfortunately, the first thing it means is that they probably are practicing on your portfolio, because they actually didn't buy, I guess, the funds that ended up being the best right out of the gate, so they're having to make up ground and maybe do a little bit of practicing. You know, mutual funds have dozens, even hundreds of stocks in them. It's not just one stock. So let's just say a mutual fund has 100 stocks in it, just for easy math. 83% turnover would mean what? Just like the company, if they had 83% turnover of employees, what would that mean? Well, that would mean that 83% of them are walking out the door and they're having to replace 83% of them through new hiring. Yep, that's exactly what it would mean for the company. So it's the same with our funds. When they're turning over 83% of the stocks, it means that they're selling what? 83% of the stocks. Right. And then they're having to replace them with 83 new ones. And just like the manufacturing company, with the manufacturing company, was all of that free? No. There were what? Costs. And do you think any of this is free, or do you think there might be costs with this as well? Well, I'm sure there are costs. Right. Because if they're doing all that trading, do they make those trades for free, or do you think that there might be some costs with those trades? Well, I'm sure there are costs with those trades, so that there are some trading costs. Also, and I would talk about this if they had some of that money, even if it wasn't all in non-qualified funds, do you get a 1099 on your investments at the end of every year? Yeah, we do get a 1099 on some of them every year, right? And a lot of that is due to the turnover we're talking about. So there's a tax cost, and here's what I mean by that. If they're, again, let's take our imaginary portfolio of 100 stocks, and there's 83% turnover. That means that each and every year, like we talked about, they're selling 83 and replacing them with what? 83 new ones. Right, so like we talked about, those trades aren't free, so there are some trading costs. But again, if they're doing that each and every year, are the gains in any of those stocks, are they long-term or short-term if they're doing it every 12 months? Well, they're short-term. And are short-term gains taxed higher or lower? Well, they're taxed higher. So you might have to be paying that 1099 you get. Some of that are short-term gains on the turnover that they're doing. So not only are there trading costs, but there might also be what? If you're getting that 1099, there are also what? Well, tax costs as well. Right. So we have trading costs. We have tax costs. But also, just like the manufacturing company, We said that the new employees, were they as productive as the old employees right out of the gate, or did it take some time for them to ramp up? Well, it takes some time. So there's some productivity or opportunity cost there. And just like here, we have the trading costs, we have the tax costs, but guess what else we have? We have that opportunity costs. And here's what I mean by that. Let's say today's the day that they're going to trade one of the 83 stocks that they're going to trade that year. So when you and I own a stock, we might own $5,000 or $10,000 worth of that stock. But these mutual funds have hundreds of millions of dollars in them. So when they own a stock, they might own $4 or $5 million worth of a stock. So let's say today they're going to sell the $5 million worth of that stock that they decide to sell. And what do you think happens when they sell and sell and sell $5 million worth of stock between 9 and 10 in the morning? What do you think happens to the price of that stock? Well, I imagine it goes down. It does, because of something called supply and demand. If you just unleash this $5 million worth of supply, if you have more supply than demand, what happens to the price of something? It goes down. So as they're selling and selling and selling and selling and selling this $5 million worth of stock that they decided to sell that day, the price of that stock is doing what? It's going down. Right. So by the time they're done with that, they might start with $5 million worth of stock, but because the price is going down as they sell and sell and sell and sell and sell, they might end up with $4.5 million worth of cash. But now they have to turn around and use that cash to buy what? A new stock. Right, so what do you think happens to the price of the new stock when somebody comes along and wants to buy $4.5 million worth of that new stock between 10 and 11 in the morning? It goes up, right? Because there's huge demand. There's more demand than supply, and whenever there's more demand than supply, what happens to the price? It goes up. So they take this $4.5 million worth of cash and they buy and buy and buy and buy and buy and buy and buy that new stock, and all the while that new stock, the price of it is doing what? Going up. So the price was going down when they sold the old stock, but the price is going up as they buy the new stock, so that they might start the day with $5 million worth of the old stock, but only end the day with $4 million worth of the new stock because of the price of that going down as they sold and up as they bought. And that's $1 million now that they have to make back just to get to ground even. And there's a cost to that. There's an opportunity cost. And the cost to you, like we talked about, and remember, they're looking at this, is $8,528 based on the amount of money that you have in those investments.
And Jeff, did we just pull that number out of the air?
No, we don't pull that number out of the air. That number is actually a real number that gets calculated for you when you're using the proposal. So the proposal will take your inputs from the fact find, from the investment statements, and the Morningstar reports, and calculate that for you so that it'll give you an individual number tailored to that individual investor, and it'll give you a turnover rate tailored to that individual portfolio based on those inputs.
So that's going to look different for every single client based on the investments that they're in.
And I actually just pulled this off of a real proposal on a real portfolio.
And guys, the turnover costs have been hammered by the Wall Street Journal, by New York Times, by Business Daily as being the biggest ripoff of mutual fund investors and variable annuity investors in the industry. Why? Because, Jeff, is there any place in the Morningstar? Is there any place in the contract? Is there any place in any piece of paperwork that the client gets that will tell them about this cost unless we calculate it for them?
Nope, absolutely not. So I guarantee they're hearing about this for the very first time.
And how many clients would be upset if they found out about an $8,000 cost that wasn't disclosed in their statements, wasn't disclosed in the guys, this is crazy that they're being charged without even knowing it. It gives Bogle an aneurysm, John Bogle an aneurysm because this isn't being reported. So this is the first time they see it. They're going to be a bit surprised.
Yep. And our job is to get them to go from being surprised about learning about this from the very first time to being angry. And I don't know that it's, now in this case, you know, I don't know the size of the portfolio. Maybe they take a look at an $8,000 cost and be angry. But that's not the point. The point is, I know they'll be angry if they tell me that they weren't told this. So I'm going to ask them, you know, did you know that this was there, or is this the first time that you're hearing about it? And like we just talked about, there's nowhere in any prospectus, there might be something to tell them that there is such a thing as turnover cost, but it won't tell them what it is for them. The first time that they'll hear that is from us. And so they'll say, no, we had no idea that was happening. That had never been shown to us or explained to us before. And then the next question is why? Why do you suppose that this hasn't been explained to you in the past? Now, they're not going to say, I don't know, because you will have, this comes late in the meeting where they're telling you things haven't been disclosed in the past. But even if they said, I don't know, we just say, well, let's think about this for a second. If you knew that there was this cost built in to that investment, would you, like the manufacturing company, would you shrug your shoulders, or would you, like the manufacturing company, want to know if there were ways that you could get that down? Well, no, we'd want to know if there were ways to get that down. And that might involve investing in other funds with lower turnover costs. So why do you suppose your advisor doesn't want you to know about the turnover? Well, I don't know. Well, if you knew about it, would you have invested in these funds, or might you have looked at others that had lower turnover? Well, we might have looked at others. And so you might not have bought these, right? And then why does he want you to buy these investments? Well, I'm sure because he wants to make money, right? So if you hadn't bought these, what would that mean to him? Well, he wouldn't make the money. So why do you suppose he isn't explaining all this? Well, because he doesn't want us to change our mind and not do anything or do something else. See, it all comes back to motive. See, I didn't leave the bank because of the $30 fee. It was a lot of trouble to change banks. It's not easy to change banks. It certainly isn't as easy as, at least I thought it was going to be easier. I knew it wasn't going to be easy. I thought it was going to be easier than it was. It turned out to be hard. But even when it got hard, I was bound and determined to do it because why?
The principle.
Yeah, they lied to me. And I was angry, and this is my way of letting them know that's unacceptable. And so when they find out that there are things in this portfolio that they haven't been told, also that he can make a little bit extra money so he can make a sale, afraid that he'll lose a sale if all of this comes out, it's the principle. That's unacceptable. And moving the account is their way of signaling that that's unacceptable. We're not going to work with people who do that.
So I want to make sure you guys are clear on what Jeff is saying here. If you just point out that they're spending $8,000 too much in turnover costs, they'll be angry, go back to their guy and say, I don't like this, and what's he going to do? Move it to someplace that doesn't have that kind of turnover cost. What do you get? Nothing. So Jeff is saying here that it's not the $8,000. You have to get them to the point where they understand that the $8,000 was done on purpose by the advisor. Now, and as Jeff's pointing out, do we tell them that the advisor did this on purpose? No. We never say a bad word about the advisor. We ask them questions until they come to their own conclusion. The reason he hid this from me is he wanted to make more money off of me. You'd have to get it to that point, or it's worthless. You cannot just get people mad at the investments, because we're not about having them get mad at the investments. That's crazy. There's no perfect investment out there. The purpose of this is to show them that this was not disclosed to them. They were never told about this. That's what gets them angry. So you can't stop at $8,000. That's a ripoff. Well, that's crazy. I'm going to change that. That's not good. That's not achieving anything. It's $8,000. My advisor's taking that right out of my pocket. Now that's what you want to hear. It has to be about the advisor didn't disclose it, not about the actual cost itself.
Yeah, and Mike brings up a good point. How do we know whether or not the clients are upset by this discussion over turnover? Well, we know because they tell us. So guys, it's important, two things. That number one, that we make this all about disclosure. Like I talked about at the beginning, the fees on a no-load portfolio are not going to be as high as they would be with a variable annuity or a B and C share or other kinds of accounts. So the likelihood that you're going to end up at a number that's going to really make them angry is low. It has to be about disclosure because it doesn't matter the amount. Just like it didn't matter the amount with the, at some point I forgot the fact that we were talking about a $30 fee. Because guess what the bank offered to do when I decided I was going to move my money?
They'd waive it.
They'd waive it. They said they were going to waive it, and guess what? They were going to credit me back all those $30 fees for the last 9 months. They were going to give me back $270. They were going to put $270 back in my account. Not only were they not going to charge me anymore, but they were actually going to reimburse me for the fees that I had been charged. And guess what I told them?
Well, so you're going to rip me off. And then if I catch you, then you'll go ahead and reimburse me.
And that's what I told them. Go jump in a lake. I'm moving my account. It's not the $200. See, that just made me even angrier. They didn't get it. It's not the $270. It's the fact that
they were taking advantage of you.
They took advantage of me. And that's where we have to get to with our clients. And that's what they have to tell us. They have to tell us, I'm angry because he didn't tell me. He hid it. He knew I might change my mind if I saw that, and that's why he didn't show me. That's why he made sure that I didn't see it. They have to tell us. It has to be about disclosure, and they have to be the ones telling us that's why they're angry. So, do you think it's easier to talk about something that's tangible or intangible? I mean, obviously, it's easier to talk about something that's tangible. So when we talk about fees, they can seem rather intangible. Because a lot of these fees, they're not showing up on their accounts as some subtraction. But they're real. And they understand that they're real. But because it's easier to sell a tangible versus an intangible, our goal is to make it real. And the way that we do that is by using the Morningstar reports, because they'll tell you what the turnover rate is. It'll be there in black and white. That makes it very real. And also, use the proposal. The proposal takes and makes not only this topic, but all of the topics that we talk about, and most of them are somewhat intangible, and makes them all very real. So my suggestion and my plea, I suppose, is if you're not using the proposal, and I know that there are a lot of guys that don't use it, start using it. It makes a huge difference. It makes it tangible for the client, and it also keeps you on track and makes sure that you're going through things from the things that get them disappointed first, then irritated, then angry, so that you're covering things in the right order. And it also helps to keep you on track so that you're covering things not only in the right order, but the right way, focusing on disclosure and not trying to sell any other way.
Okay, and I'm going to jump in here because we have a question, because you're exactly right, Jeff, and it kind of rolls into what this question is. Should you lead with, hey, do you pay any fees on your portfolio? So let me hear what you guys think of that. Should I lead? First of all, every single script for every single one of these things is right on the website. So if you want to know how to deal with fees, you go to the website on Disclosure Meeting, go to fees, and we'll tell you exactly what to say. But this is a good question, because that's our natural inclination to say, hey, do you pay any fees on your portfolio? So let's get some answers to this. How many of you think that's how we should start? No, 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 Eric says. Exactly right. What do you want to do? Make the client look stupid? How many sales do you get? And this comes from me. I was the biggest, I was guilty of this more than anybody else. The years I was making 50 grand a year, so the first 8 years I make 50 grand a year, I was an excellent debater, and I would trap my client and trap my client and trap my client and make them look idiotic to prove my point. How many sales did I get? So I won the battle, lost the war. It's only when you start to let the client discover this stuff for themselves that it starts to work. You cannot be aggressive and try to trick them into things. It's okay. Now, there's a subtle difference here. So do you want to say, hey, do you pay fees on your accounts right now? Aha! Yes, you do. Is that what you want to do? Really? No. Now, what you do, it's a subtle difference. What you do is say, hey, do we want to pay fees on our accounts? So is there a difference between me saying, hey, do you pay fees on your accounts, and me saying, hey, do we want to pay fees on our accounts? Is there a difference there, guys? Let's see some explanations. No, they will stop listening if you think they do not pay fees. Well, yeah, there's a big difference between, hey, I'm going to say it again, guys. I want you to understand. It's subtle, but it's big. Which is, hey, do you pay fees on your accounts right now? And instead saying, hey, do we want to pay fees on our accounts? See, with the do you pay fees on your accounts, you're basically trying to trap them in a corner. Because you're going to prove to them that they're wrong. They do, because they're going to say, no, I don't think so, or maybe a little, or whatever, and you're going to show them they're wrong. That's not what we want to do. But instead, when I say, hey, do we want to pay fees on our accounts? Or how big of fees do we want to pay on our accounts? It's a philosophical conversation. And then we're going to get on their side and let them explain to us. We're not going to tell them why they shouldn't be paying fees on their accounts. We're going to let them tell us why they shouldn't pay fees on their accounts. And then we always say, well, that's what concern. After we've agreed with them and we're all on the same side, and we're like, yeah, then we say that's what concern. We have the same formula. We have the same formula for every single one of these things that's in the proposal that Jeff's talking about, which is we ask them why they're doing something, then we agree with them and tell them how smart they are, and then we say that's what concerns me. And then where do we place the blame? We show them that's not what's happening, and then we place the blame, or allow them to place the blame where? On their advisor, not on themselves. If you say, hey, do you pay fees right now? Then what you're doing is you're placing the blame on them for being stupid. Instead, when we all agree that we don't like paying fees, then it's easier to put the blame on the advisor. Do you get that? So I also have a comment. Because there's usually, so let me read this comment here. Because there's usually many mutual funds in portfolio. Do you use the average turnover cost, total turnover ratio divided by the number of mutual funds, or do you use a weighted average, Jeff?
No, it's just it's an average. Yeah, it's a straight average.
Because I agree, Casey. Sometimes, I mean, I've had, and Jeff, you still do these, there's 15 different mutual funds.
Yep.
And so do you really want to do a weighted average? I mean, that would be hours of work. What's our point, guys? Is our point the exact number? No, what's our point? This stuff was not disclosed. How about for fund manager tenure? Do we weight that, Jeff?
No, we don't weight it.
Because our point is not about the exact number. No, the point is, has this been disclosed? Now, guys, the only reason we're able to do a proposal like this is full-blown financial planning. How many advisors do this stuff, guys? How many advisors go through all 21 things that we go through? Zero. No, I'll take that back. There are advisors who do that. Guess who they work with? The ultra-wealthy. Guess what they charge? $5,000, $10,000 to do a financial plan. Are we charging people? No. Are we working with people with $5 to $10 million? No. We're working with people with $100,000 to $2 million. So we have to be efficient at this. So we do it the quickest way possible to have them discover that their guy isn't disclosing these things. So it's not about giving them the exact number. Yeah, go ahead, Jeff.
Yeah, and if you look, it's all about disclosure. It's all about whether or not things were hidden. And if you stick to that, the issues melt away, and the obstacles to a sale melt away, and the likelihood that they're going to go back to their guy and leave you a message saying that they decided not to do anything goes away. If you try and make it about the number, I don't know what's going to happen. Well, I guess I do know what's going to happen. They're going to go back to their guy angry.
Yep. He's going to say sorry.
Because I've seen it happen lots of times. I've heard stories from you and say, you know what? Because here's the thing that happens. Either they get talked out of what you told them. That's one thing that could happen. Or they don't get talked out of it, but they get given a different point of view, and so then they think, gee, you know, what Jeff said really made a lot of sense, but what my other advisor said makes sense too. I'm just not sure. So what's the best thing to do when you're not sure?
Do nothing.
Nothing. Leave it as it is. So, you know.
And then I have another question here.
It's stacked against you guys unless you compete on the one thing that you know for a fact you can win on, which is disclosure.
Yeah, absolutely. And you see that a lot with rates of return, right? The guys get, oh, this is a done deal because the market just tanked. That's stupid. It's stupid to go in there when the market just tanked and make that a reason to move the funds. Because then what's going to happen between now and when you move the money? The market's going to recover and you've lost the sale. So, but we have another question here, which I think could make an excellent point again. Would you also say, quote unquote, one would expect that your advisor should tell you this if your fees were in a portfolio? Guys, do you think we should say that to a client? One would expect that your advisor should tell you that there are fees in your portfolio. Is that selling, telling, preaching, and teaching? R.C. Chase says no. Exactly. That's selling, telling, preaching, and teaching. And do clients like you to preach at them? No. So if all of these scripts are on the site, and what do? We never state anything. If I say one would expect an advisor to disclose the fees, am I making a statement, guys? One would expect an advisor to tell you about these fees. Am I making a statement, guys? Would you consider that a statement? Let's see some answers. Yes, I'm preaching, exactly. The only person they're going to believe is who? Who's the only person they're going to believe? Me? No, I have a vested interest. I want to sell them something. Who's the only person they're going to believe? Themselves, Eric. Exactly, themselves. So is it okay if you ask questions where the client says, well, one would expect the advisor to tell me about fees in my portfolio? Would that be okay? Yes, it's okay if they say it. So ask them a question to get them to say that. But if you say it, all you're doing is, again, making them look stupid. Nobody likes to be told things. Nobody likes to be preached at. They want to discover it for themselves. If they discover it for themselves, it's okay. If you tell them, then they're going to disagree. So it's not okay to say, I'd expect advisors to tell you this. No. Is it okay for the advisor or for the client to say, you know what, I would have expected my advisor to tell me this? That's okay. We don't make statements. We don't make accusatory statements ever. Like I said, Jeff, do we ever say a bad syllable about the other advisor?
No, never.
But to the client, if you do this right, do the client say bad things about their advisor?
Yeah, absolutely. That doesn't mean things that are bad or negative don't get said, but they always get said by the client.
And again, guys, I spent 8 years saying bad things about showing clients that they were stupid and showing clients that their advisor was screwing them. And it makes you no money. The thing that makes you money is when you learn to ask questions so the client discovers it for themselves. Not that they're paying too much, but that their advisor did not disclose that they were paying all these fees because it would hurt the advisor's bank account. That's when you start making all sorts of money and really providing a wonderful service to the clients. Because you're getting them out of working with somebody who's only got the vested interest of themselves in mind. So we're not hurting the other advisor, because if they're a true advisor, they would have disclosed this stuff. We're hurting salespeople taking advantage of clients who don't know any better. That's our job. And we do that by not telling the clients they're stupid, but instead letting the clients learn by asking questions for themselves, and they feel a lot better about the decisions that they're making. So this is an important thing for you guys to understand, this turnover cost. And I know there was a lot of confusion. That's why I asked Jeff to go through it. So I appreciate it. Was this helpful to you guys to understand what this turnover cost is and how we use it? Super. I'm getting some yeses. So anything else, Jeff, before we let him loose?
Nope. That's it.
Okay, well, thanks, Jeff. That was an excellent job, and I appreciate all you guys being on the call. And I hope you have a wonderful week. Thanks, guys.